This is a presentation partly that we have been beginning since we've seen interest rates coming off, and we've really seen the surge in the equity market, and we think there is quite a bit of opportunity still remaining within the equity market. So we wanted to give an update in terms of our overall equity strategy and touch a little bit more specifically on specific stock recommendations. We of course did touch of this earlier on in July and also in August as well, in terms of our overall strategy, with a brief on a couple of sectors that we have been positive on. But this is a little bit more of a deep dive and update into our strategy and thinking going forward. There will also be a Q&A session towards the end. So if you have any questions, please direct them towards Capital Alliance on the Zoom chat, or you can direct it to myself directly as well. So in terms of the market performance so far, since the domestic debt restructuring announcement has been made, market has moved up by about 13 to 15% or so. So we've seen quite a strong run that has been seen. There have been some corrections, and these are healthy market conditions to be in. And we do think that there is quite a bit of upside left. Of course, the key catalyst that we do see is that lower interest rates are going to support this equity market growth. In terms of our interest rate expectations to start off with, in terms of the central bank action so far, we've seen that the central bank has moved towards an easing stance. They've already reduced rates by 450 basis points in terms of the overall policy rates. And we've also seen the statutory reserve ratio being reduced as well, another measure of easing overall. And of course, in the last monetary policy statement, we did see certain administrative measures being taken in terms of bringing down overall market and specifically lending rates in terms of pawning, overdrafts, as well as more recently in terms of bank lending rates as well. In terms of the direction overall, in terms of policy rate reduction, we think that there is another 200 to 250 basis points reduction that the central bank will take in its following two meetings before the end of the year. So we expect a reduction rather in policy rates further going forward, in addition to what has already been seen and enacted so far. A couple of the main drivers here, of course, have been that inflation has been coming off at a much faster pace than anticipated, both in terms of the central bank's inflation expectations, as well as in terms of some of the IMF's inflation expectations as well. And this has, of course, been a key catalyst. So we've seen the appreciation of the currency helping to some extent. Demand has remained quite constrained. And of course, supply side conditions have gotten better. And that's why we're seeing inflation coming off, of course, helped by the statistical base effect of very high inflation, which we saw towards the second half of last year. So we're expecting inflation to reach very low single-digit levels in the third and fourth quarter of this year. We've already seen it being quite low at about 6% last month, and we think it can continue to reduce. So we are in line with what the central bank's thinking on this is as well. In addition to that, there is also an output gap that needs to be addressed in terms of ensuring that we can rein in the post-crisis recovery cycle, economic recovery cycle. Central bank has mentioned that second quarter GDP will still be negative, although they see more prospects for the second half of this year. So that also gives further room in terms of cutting rates to allow the economy to grow, while also enacting measures in terms of stimulating credit growth that will drive overall economic growth as well. So in terms of where we expect market rates to be, we expect the 12-month Treasury bill rates to decline to between 10 to 12% by the end of the year. In terms of AWPLR, of course, right now, there's been a little bit more guidance that has been provided as of yesterday in terms of where they expect bank lending rates to be by the end of the year, which is to the tune of about 13.5% by the end of the year, about 14.5% by end of October, and 13.5% by the end of the year. So this is very much again in line with what we have been forecasting in terms of where interest rates will be towards the end of the year. And this, of course, becomes a strong catalyst in terms of how equities will perform. And you can, of course, see that relationship that has been tested time and time again. So again, in terms of summarizing our interest rate view, it is mainly driven by the fact that inflation will continue to remain quite low. There is a steep reduction in terms of the risk premium that has been seen since the domestic debt restructuring announcement that has been made. And we haven't really seen it increasing since that point, despite there being certain extensions being given so far in terms of the deadline. There hasn't been a steep increase in that. And also, we are also seeing that monetary financing is overall reducing. We're seeing a lot more budgetary support coming in from international foreign agencies, such as the World Bank, as well as the ADB, where they've given a lot more budgetary support. And this, of course, reduces the strain in terms of domestic financing of the budget deficit, which again feeds in well in terms of liquidity and also allowing rates to come off further. So because of this strong catalyst, particularly being interest rates being low, we are very positive in terms of the revival that we will see in equities. We've already seen quite a bit of it happening since July, this strong uptrend that we have seen so far. We expect that it will and it can reach around 12,500 levels in terms of the overall ASPI by the end of the year. Again, driven by further policy rate cuts and a lot more strong positive momentum that we will see going forward with the conclusion of the debt restructure overall, and also pick up in growth and corporate earnings that we are expecting to see in the period ahead. So in terms of the liquidity shift as well, this is another thing that really drives it home. In terms of the reduction in interest rates, how does this, impact the ASPI? You can see that even in past periods, in times when the market interest rates are reducing, you can see that the ASPI sees a strong recovery. And this has happened over and over again. And now this is what we're seeing in the most recent period as well. So we expect this to continue with interest rates coming down very sharply from the highs of over 30% that we saw last year. There's strong room for the index to grow and possibly even surpass its previous highs over the next 6 to 9 months. So in terms of how equity investors, or rather investors, view this overall phenomenon as well, what we see is that if you're, for example, looking at investment opportunities, right, you think of where can you place your money. Of course, when interest rates were high, that opportunity was great in terms of the return you could get by investing in fixed income securities, whether it be a treasury bill, bond, or even fixed deposits. But now you're seeing that the differential has changed. For one, there has been a higher tax that has been imposed overall in terms of individual income tax. So in addition to the withholding tax of 5% that one would pay in terms of their interest income, they would also have to pay an additional amount in terms of their personal income tax that would also fall within this. So effectively, you're paying at the highest bracket, you will be paying a 36% tax on your interest income. So you can see that in the past as well, that this phenomenon, particularly over the last year, interest being invested in fixed income was a lot more attractive. But now you're seeing that this return has started to fall quite dramatically. And instead, you're seeing that the ASPI returns are looking a lot more attractive. So for example, right now, if you were to invest in a 1-year fixed deposit, say at about 9.5 to 10%, your effective return after tax is only going to be about 6 to 6.4%, which is quite low compared to the returns that we have seen the market making, particularly over the last weeks. And if you look at it on a year-on-year basis as well, there's a lot more advantage in terms of investing in equities right now. And that's also how we see the liquidity shift taking place as more and more deposits mature at the previously high interest rates and get repriced downwards at the new deposit rates, which are close to single-digit levels across the board. We'll see that that option looks a lot less attractive, even on a tax-adjusted basis, and therefore that liquidity has space to shift to higher yielding assets such as equities right now, and that's really where we see quite a bit of opportunity right now. And one more thing to note, in terms of capital gains on equities, there is no taxation on that. So again, on that front as well, it does look attractive. And this is just considering the ASPI. If you add on dividend on top of this, there is a 15% tax on that. But effectively, you would still get a much higher return compared to investing in fixed income right now. And we see that shift taking place, driving more liquidity into the equity market and driving up and kind of continuing this improvement in the terms of the equity market wave that we're seeing. Another big catalyst is, of course, in terms of the market re-rating that we would be expecting, along with the overall economic recovery that we would see, particularly in the second half of this year. Again, this language was iterated by the central bank in terms of the economic recovery they expect in the second half of the year. But to start off with, in terms of the market re-rating, of course, we have seen the market move up quite significantly since early July. But if you look at it in terms of an inflation-adjusted basis, there is still a significant gap in terms of the market capital, not in nominal terms, as well as inflation-adjusted terms. And you can see that gap has not really narrowed as much even over the last couple of weeks. There is still a substantial differential that would need to be kind of caught up on if you're even to kind of reach levels in terms of inflation-adjusted levels that we have seen over the last 8 years. There's quite a bit of room for increase in terms of the overall market cap there as well. And we see that happening going forward. In terms of what will kind of push this as well, one is, of course, in terms of the foreign investments into the overall equity market. In the first half of the year, there were quite a bit of foreign investments in terms of the bill and bond market, particularly in terms of the bill market, with about 500 million in terms of inflows being seen. So we do expect that equities will now also take the forefront in terms of foreign investment looking into this country. We're seeing a lot more interest overall in terms of attractiveness within the region as well. And you can see that there has been much less foreign turnover over the last couple of months. It has started to improve now, but it is not near the levels that, for example, of 32% of contribution of market turnover that used to be seen on average in certain periods, being much higher than that, 40 to 50% of market turnover being contributed through foreign inflows overall. We do see that this number will start improving, and it has seen that momentum, particularly over the last couple of weeks. And this also will be able to drive the large amounts of liquidity that is needed to kind of keep the market up overall. And in terms of, again, in terms of economic recovery and how this trickles down into the companies themselves, what we're seeing is that GDP growth, the market has always been a leading indicator or a forward indicator of economic growth. And now that we expect GDP growth will be much stronger in the second half of this year, while overall the full year number will still be about a negative 1.5%. We see next year being around 3%. There's quite a bit of growth that we'll see from the second half onwards, continuing into 2024. And as a result of this, because the market is more of a forward indicator, we see that there is room again for within that as well for ASPI returns to be quite strong in this period of growth that we have seen past the troubles that Sri Lanka has seen over the last couple of years, and particularly within the last year with high interest rates, growth being constrained, all of that coming in. Now we're seeing some of that phasing out to some extent, and as a result of that, GDP growth continues, and as a result, ASPI returns will reflect this growth that is expected. So part of the reason that drives this growth, of course, is the normalization of economic activity, but also an increase in terms of credit growth. Again, once again, driven by lower interest rates as well. And we do think that this is a very strong reason as to why the central bank is quite adamant in terms of lowering market lending rates, and these actions that have been taken, particularly over the last 2 days, in terms of interest rate caps on several lending instruments have been implemented with efforts to ensure that there is credit growth that takes place, and as a result of that, that there will be economic growth. We have always seen that relationship between banking sector lending growth or overall private sector credit growth, as well as economic growth. So there is quite precedence in terms of credit growth driving economic growth overall. And if you look at the graph on your right in terms of banks' willingness to lend, of course, with non-performing loans or stage 3 loans rising in the past several periods, the last couple of quarters, you have seen that banks' willingness to lend and people's willingness to borrow has actually been quite negative. And this is a survey conducted by the central bank, but the tide has now turned. Second quarter, there was a little bit more willingness to lend by banks, but for the third quarter, this has turned a lot more positive. And even in terms of the demand for credit, this is now turning more positive. So we see these as positive signs for the growth that we expect in the second half of this year. And how this trickles down into overall corporate earnings is, of course, that we will see a finance cost of companies coming down significantly. This has been a strain in terms of bottom lines of a lot of companies over the last year, borrowing at AWPLR plus 2-3%, in certain instances, borrowing at Treasury 3-month Treasury bill plus 2-3%. And this has, of course, been a huge strain in terms of bottom line. So despite there being some resilience on top line, even in certain companies, their bottom lines have been completely eaten up by finance costs increasing. And now we see that this pressure is going to start coming off in a large way. We saw corporate earnings continue to dip over the June quarter, but we do see that there's going to be a pickup in corporate earnings, and we expect a pickup in corporate earnings from the third quarter onwards, particularly driven by finance cost reduction, although there will be some level of top line improvement across certain sectors as well, although that might take a little bit longer to kind of kick in. But we see that the bottom line prospects are a lot stronger, and you can see that there is going to be a significant change if you look at just the second quarter, the June quarter numbers, and you adjust it for 500 basis points reduction in the lending rates. You can see that there is a substantial improvement, almost a doubling of the overall bottom line earnings. This is excluding banks, finance, and insurance companies. You can see that there is almost a doubling of earnings with all else equal that we will see just from an adjustment in terms of the finance cost. And with corporate earnings also starting to improve, this bodes quite well in terms of the overall equity market prospects that we see going forward. So moving on in terms of our stock picks. So we will keep this section a little bit more brief, a little bit more expanded compared to what we presented last time, and dive in a little bit more into certain companies as well. So the first one, as we've been talking about so far, is really in terms of how interest rates are going to affect company and how low interest rates will really help companies to see their bottom line earnings grow. There are a couple of key companies that really stand out, although across the industry, a lot of them will see that benefit, except those that have dollar-based borrowings, which haven't seen as much of a reduction yet. So a big name that really comes to mind and a big beneficiary of interest rates coming off, we see is Haley's. Of course, in terms of their top line, there is quite a bit of pressure given their exposure to, in terms of the exports sector overall. But we also see that just based on, they have also been quite impacted overall by the increase in finance costs over the last year, which has been taking up about 70% or so of their overall, which has removed about 70% of their earnings before interest and tax, or their operating profit. If you, for example, effective rate was at about 21% over the last quarter in terms of their finance cost. But if this reduces to, say, about 15% by this quarter, with all else equal, which is keeping the operating profit the same as it was last quarter, you would see in terms of the bottom line increase, there would be almost 100% or a doubling of that bottom line increase that we would see within Haley's alone for the next quarter. So if there is top line improvement, this of course improves further. But we can see just based on finance cost adjustment alone, from the effective rate coming down from 21% to about 15%, you can see that there is a strong adjustment that can be seen in terms of their overall bottom line. A couple of other companies that also come into mind in terms of those that will benefit very much from these lower interest rates are, we see this as being the supermarket or the retail segment stocks, consumer segment stocks, where they have invested heavily in terms of working capital over the last year in terms of inventory overstocking because of product unavailability, and as a result had to incur higher than usual short-term borrowings in particular. And as a result of that, we see that coming off in terms of the overall borrowings figure, but also in terms of the bottom line perspective. For example, Ceylon Coal Stores, you can also see that there is going to be an improvement in their earnings, again, keeping all else equal in terms of their top line. They have seen quite a bit of growth coming in terms of footfall, 15% of growth coming in terms of footfall over the last quarter, and this can improve quite a bit. So we are positive in terms of their top line prospects. But even if you keep that aside and just adjust their finance cost component alone for this quarter, you can see that there is still an improvement that they would see 9% up on a year-on-year basis and 48% up on a quarter-on-quarter basis. We see that they are paying down some of their debts, but overall, assuming that stays at the same level as well, just the reduction in the rate alone helps them to kind of improve their overall bottom line. Similarly, similar to Ceylon Coal Stores, Cargill is also to some extent had been affected by these higher finance costs because of the higher borrowing, although to a little bit of a lesser extent. About 40% of their EBIT was taken off due to the finance costs that they incurred over the last year. And we see this improving going forward, again, keeping all else equal, although we are positive in terms of their top line prospects as well. If it remains at the same level as last quarter, you can see a 50 to 60% kind of growth, both on a year-on-year as well as on a quarter-on-quarter basis for these kind of companies. So there are further beneficiaries within this, but in terms of big names that we see these as being some of the largest beneficiaries of interest rates declining overall. Once again, to kind of mention, a lot of these companies have debt denominated in terms of rupee terms, but if you're talking about companies that have dollar denominated debt, that hasn't changed as much. But if a company and looking at has more rupee denominated debt, the effective finance cost or effective interest rates at these levels, at the last quarter levels, would be anywhere between 80 to 20%. And if this reduces to say 15% or even 13.5% as the central bank expects it to be by the end of this year, there is quite a bit of a benefit on the bottom line that most companies will start to enjoy. In terms of consumer recovery as well, we've seen the prospects for this actually improving quite a bit, particularly in the last quarter. So some of the earnings were, of course, still disappointing, but the underlying indicators were a lot more positive. And we've seen that kind of seeping in to growth going forward in the second half of this year as well. So in terms of overall consumer sentiment, business sentiment indexes as well, you can see that we're standing at highs that were seen even in a pre-crisis level. It's higher than those levels. And this, of course, gives you an indication of people's spending patterns, people's ability or willingness to spend, as well as how businesses view consumer spending, as well as their own business growth. And so you can see that this optimism really has started to improve compared to where we were, say, 1 year ago at this particular point in time. There's been a steep improvement of that. And we can see that certain underlying indicators are also starting to improve. So, for example, in terms of the numbers that Ceylon Coal Stores reported in terms of their same-store footfall growth, you can see that, for example, the fourth quarter of the year, there was barely any growth, staying flat at about 0.1%. But of course, in the most recent quarter, they've reported close to a 15% growth in footfall growth. And this is coming off a relatively high base as well, where numbers were distorted a little bit in the previous year that we saw based on lockdowns and changing mobility conditions. There's a bit of a discrepancy in the first 2 quarter numbers for last year, but these numbers are a lot more reflective of more actual conditions, and these underlying prospects for particularly the consumer segment we see as being a lot more positive, even in terms of the numbers that HEMAS reported in terms of their volume reductions have started to really reducing. So we're seeing this being a lot more of a positive trend. And as a result, the companies that we would recommend within these sectors, within this sector is HEMAS, Ceylon Coal Stores once again, Cargill's, CTC, Distilleries, Chevron, Melstar, as well as Sunshine, which are all based in the consumer segment, although they do fall into different categories. We see that the improvement in economic activity and consumer sentiment and spending overall will drive growth for a lot of these companies. Some of them, of course, in terms of, for example, CTC and distilleries, we see that there is some level of volume pressure coming in, but we also see that their margins have continued to be maintained. And as a result, within the consumer space, we see this as being stocks to be more positive on going forward. So as I mentioned, in terms of the overall market rating and how investment is looked at within this South Asian region and now in Sri Lanka as well, because of the progress that we have made in terms of our debt restructure, there are a lot more eyes on Sri Lanka now compared to what it was 1 year ago when it was when we were in the middle of the crisis. We see the recovery path coming in, the numbers in terms of the macro side, all of them are looking a lot more positive. And as a result, there are a lot more eyes in terms of Sri Lanka as a good destination for foreign investment. And as a result of that, we see that the counters that foreign investors typically tend to lean to in terms of investment tend to be the larger caps. So you have JKH, for example, Ceylon Tobacco, Dialogue Distilleries, once again, as well as Sunshine, that has come in to focus a little bit more. And you can see that their foreign holdings, even in the past, have been quite high. It has dipped a little bit since then. Some of these have dipped, of course, much more than the others, which gives them space to kind of move up as foreign investors start coming in and again looking at these same counters because they are still the more larger liquid investable counters. And as a result of that, when these quantums of funds do start coming into this, there will be adjustment in terms of what takes place, both in terms of the overall market, but also in terms of some of these specific stocks that we have highlighted over here. We'd also like to highlight dividend yielding counters right now, particularly the differential if you're looking at it again in terms of buying and holding, fixed deposit versus dividend yielding counter. The tax rate is also lower. And there are prospects in terms of share upside for a lot of these counters as well. For example, the ones that really pay very much higher dividends are really in terms of Ceylon Tobacco, Dialogue, which has historically paid a high dividend, although they did not declare dividends last year due to the foreign exchange impacts that they felt. Distilleries right now standing at above 25% dividend yield. Chevron, again, has seen a much higher dividend play in the last period, as well as Melstar Corp as well. So a lot of these companies paying high dividends in excess of 15%, particularly in the last period, will look a lot more attractive if you want to buy and hold rather than taking too much gamble in terms of share upside. But all of these counters, again, as I mentioned, we are still positive on in terms of their earnings cycle as well. So as a result of that, we do see a lot of these companies trading at very attractive price to earnings ratios right now compared to the historical averages. Again, very similar to the consumer segment that we highlighted before. A lot of these counters, again, are trading at undervalued in terms of their price to earnings ratios as well, which makes them, again, a lot more attractive from an earnings perspective, but also some of them in terms of a dividend perspective as well. So in terms of a couple of key sectors to highlight, one, of course, that we see upcoming really is the tourism sector. We've seen the numbers for tourism, particularly in this July and August season, coming in almost double in terms of the earnings, particularly compared to what we saw in the first half of this year. And we do see that towards the end of this year with the winter season forward bookings looking a lot more positive. There could also just be event-driven tourism coming in the fourth quarter of this year. And we see that we would at least be able to reach kind of 80% levels of what was achieved in 2018 in terms of overall arrivals by the end of this year, which is a very strong number because 2018 was the best year in terms of arrivals that Sri Lanka had. And in 2024, we believe that we can actually surpass the earnings, at least, that we earned, that we will see going forward. So it is not necessarily a near-term play, but we also see these numbers really starting to pick up from the second half of this year and also going forward from next year as well. Again, companies like John Keel's Holdings with Cinnamon Life opening up, the casino operations that might begin, all of this being able to drive tourism into the country. The frequency of flights have really started to increase compared to where we were a couple of months ago. This, again, the opening up of the Chinese tourism market, Sri Lanka being seen as a more cheap destination. So we are able to hit several of these target markets. We are able to hit some of the key demographics in terms of the high spenders, but also some of it in terms of the volume of numbers, even though they are low spenders. We see that the earnings overall would improve, and as a result, hotel occupancies will start to increase. Of course, some of these hotels will require higher refurbishment costs because of the tourism inflow that we would be expecting. But there is also some level of favorable banking sector lending into this sector right now, given these prospects being seen. So we see that they will be poised and ready for growth in 2024. And as a result, a lot of these counters, there are quite a few of them trading even below book value. And with the revaluation that can be seen going forward in terms of those book values, you can see that there is going to be quite a bit of prospects within the tourism segment as well going forward. So another one to kind of touch on, one before the last in terms of the sectors that we are positive on, is of course the banking sector. There has been quite a strong increase that we've seen over the last 2 months or so within the banking sector. But we see that, for example, if we take, we understand that there is going to be a reduction in terms of the net interest margins with lending rates coming off, but also the cost of funds have come off as well. So there is going to be some level of net interest income growth that we would see, particularly the ability for them to lend a lot more with the statutory reserve ratio coming off. There's a lot more ability to lend. And as a result, the net interest income will continue to grow, although their NIMs may shrink. But the big upside is really in terms of the impairments that they undertook last year, which will not be present this year, or which will be present to a much lesser extent this year, and much less going forward as well. In terms of how stage 3 loans are also viewed, there's been, for example, the last year, there was a lot more impairments that were done on foreign currency denominated assets. But a lot of banks have already impaired 40 to 45% in terms of an external debt restructure. And the remaining component is now in terms of loan loss provisioning. With stage 3 loans still being on an increasing trend, we do expect it to kind of stabilize in the 3rd and 4th quarter of this year. So we do think that the impairment cycle will still be much lower compared to what it was last year. And as a result of that, the ROEs of the banks will start improving a lot more compared to the subdued levels that we saw in the last year. So if you just even take a historic average of the ROE, you can see that there is quite a bit of room in terms of a price to book value. Some of the banks still look relatively undervalued on a forward kind of ROE adjusted price to book value basis. You can see that commercial bank just typically traded at a higher price to book value will trade only at about 0.5 based on the ROE adjusted basis. And there's quite a bit of upside even in terms of some of the larger banks, HNB, NTB, Sampath, which are all banks, again, that have moved quite a bit in the last period. But there is still, we believe there's still room for further upside, particularly on a price to book value basis, based on the fact that their bottom line growth is going to continue to improve over the next couple of quarters. So we don't see this necessarily being a short-term trend that we have seen over the last 2 months, but we do think that their earnings can drive further share price improvement as well in the next couple of quarters. And along with this, finance companies, again, a similar kind of story. The ROEs we see being quite strong, particularly among some of the larger names. Of course, a lot of them have traded above or very close to the historic average book values. But there are certain counters, for example, commercial credit looking a little bit more attractive, even LB Finance, which has seen an increase with the average historic ROE being factored in and on ROE adjusted basis. It looks attractive there as well, even in terms of the portfolios they have on pawning. So you can see that the administrative measures that were implemented yesterday on rate caps are implemented on mostly on only the banking sector and not in terms of the finance sector, although finance companies may adjust their rates to come a little bit more in level with them as well. But there is quite a bit of room for prospects for growth here. Again, the relationship that they have in terms of the net interest margins is a little different to banks. In periods of low interest rates, you see that their net interest margins actually tend to improve because of how their loan book reprices differently to banks. And as a result, we see that there is still a little bit more in terms of prospects for the finance companies here as well. So just wanted to touch in terms of the banking finance sector because those are the sectors that we have really seen moving quite a bit over the last 2 months, but we do see that there's still room for growth in these sectors as well. Although the opportunity might be in certain other counters, such as the consumer sector, which will see further growth going forward into next year as well as GDP continues to grow. So those are the main companies that we wanted to highlight within an updated form of our equity strategy view, and what are the companies that we are more positive on right now and where we see further upside potential remaining. If you have any questions right now, I'd be happy to take it on. There is a question in terms of the banking sector, whether it is correct to compare historical PBV and current PBV, given that things have changed right now with the crisis that we are facing. I completely agree. A historic PBV is not going to be where banks will trade at in the future. I think even in terms of the overall sector, it's difficult to see that the banking sector will trade at book value. I think there's an adjustment that needs to be made by about 15 to 20%. So I think a reasonable PBV that you want to kind of keep for the sector is about 0.8 times. Given the adjustments that we've seen, there's been a lot more regulatory forbearance provided in the sector, not just in terms of Sri Lanka, but also globally as well. And I completely agree that we can't necessarily compare directly the historical PBV, but even if you take that kind of 15 to 20% adjustment or a discount on that price to book value, there is still room for an increase in terms of the space between the existing or the forward PBV. There is a question also on the banking sector in terms of the overall asset quality and whether we think that there is going to be any further changes in terms of the overall asset quality of the bank books. I think there has been a lot of assessment that has been done already in terms of the asset quality of the bank books, particularly in terms of provisions that they have made in terms of their impairment cycle. So I think there is a lot more care that is being taken in terms of lending going forward. While there is a push to lend and grow the economy through this lending cycle, there is also a lot of care being taken into the sectors that banks would be looking into right now. So for example, they are more carefully analyzing, even in terms of the tourism sector, for example, the companies that have really been paying their moratoriums and have started to see a lot more forward bookings. Those are some of the counters that they are more interested in. Even in terms of the agri side of things, they are being a little bit more cautious because, of course, of the drought and so on, but there is a little bit more positivity in that. Construction is something that they are still relatively wary of. So there is a lot more care being taken in terms of the asset quality of the overall loan book that we're seeing in terms of an overall strategy undertaken by the banks right now. In terms of the construction as well as manufacturing sector, there are a couple of questions on that and any thoughts on it. So essentially what we're seeing is that we don't necessarily expect a recovery overall in terms of the manufacturing and construction segment to be seen this year, but we do see that there are prospects possibly from the second half of next year. So if you have a strategy of buying and holding and you don't mind waiting maybe 1 to 2 years in terms of that return, we do think it is a good idea to kind of get into these investments while they are cheap right now and while there's a little bit more risk factored in right now, although the return might be a little bit delayed 1 to 2 years if you're an investor that is fine with taking a medium-term investment. We do see this as being a possibility. But if you're looking at short-term gains, we don't really see too much upside within this right now. We think that in terms of the consumer cycle, there'll be a shift in terms of consumers going towards their consumer staples, which is at the stage that we are at right now. Then in terms of consumer discretionary items, particularly with some of the import controls coming off as well. And thereafter, they will look at more big ticket items. And this is where the construction as well as manufacturing play would also kind of really start to be seen. Of course, within this, there are certain companies, for example, some of the cable providers, ACL, Sierra, we see that there is more upside potential for some of these companies because of how their order book is positioned in terms of the projects that they are based in, not purely being retail driven, but more commercially driven projects as well, which are slowly starting to increase. We're seeing companies investing in that space a little bit more. So I would say we are more positive in terms of companies like ACL and Sierra, even possibly Tokyo Cement as well. But in terms of the overall construction segment, I think with increasing competition coming in, with import controls being taken off as well, the upside for that might be a lot more delayed rather than immediate. There's also questions in terms of the plantation sector. Of course, we've seen tea prices were coming off in the last couple of months, but we are seeing that starting to increase going forward, with volumes also starting to be a little bit more constrained. Similar factors that were driving the plantation sector in the last year. We're starting to see things totally turning around for the plantation sector. We're also not seeing too much cost pressures. For example, fertilizer prices have stabilized compared to 45,000 per bag that was being paid last year. Right now, it's standing at about 10,000 or so. So cost pressures on that side are a lot better compared to last year. We're also seeing that in terms of the labor cost, we haven't seen a change in terms of the wage bills that have been proposed. So on the cost side, there is margin potential. And on the price side, right now, we're seeing a little bit more positivity. I think it is, in the short term, going to be more positive for the plantation sector. There is a question in terms of CTC. There's a huge increase in illegal cigarettes, and recently volumes have been down. Any thoughts on financial year 24? So that's correct. In terms of volumes, we do see that there has been a reduction, and quite a steep one at that as well, because of the continued increase in excise duties that have taken place. But this is not a new phenomenon. Excise duties have continued to increase overall in the last several years, and as a result, we have seen that volumes have also continued to decrease in the last several years. There was one exception, which was just in the last year when the excise duties on the smaller sticks were reduced, and as a result, there was a little bit more volume into that space. But now that has again reversed and gone back to what it used to be. And as a result of that, we see that volumes, of course, will continue to come down as they have been over the past several years. But what we also see is that on a margin basis, CTC tends to increase their price over and above the increase in excise duty. And as a result of that, they have continued to be able to maintain and actually increase some of their margins within this space as well. So we continue to see that as a counter that will still be growing in terms of profitability as well as revenue, despite volumes continuing to come down. There's also a question in terms of the renewable energy sector. I think there is certain prospects within this. We do see, for example, Aitken Spence as being one that is looking quite attractive right now, particularly given the contracts that the government is planning to give them with their ACE Power Ambilipitya as well as Mathura plants, which are fully depreciated assets. And as a result of that, we think that there is quite a bit of profit that can be added on to their bottom lines over the next couple of quarters as these contracts start coming back into place. We are looking at it a little bit more closely, and we will kind of update you as we improve our findings within this space. But it is certainly something that is looking a little bit more attractive right now. Yeah, so similarly with that, I think this question on short-term climatic changes and what sectors will benefit, what counters will benefit. We do see Aitken Spence as being one because of the new contract that have been obtaining. There are also counters that are within that space that are getting more projects, renewable energy projects, which tend to be a little bit more longer term in nature. Very much depends on the kind of PPA agreements that are put in place there as well. But we will keep you updated in terms of our findings on the renewable energy segment. In terms of the property and real estate segment, there is a question, because interest rates are coming down, do you see an increased potential? I would probably put this in a similar bucket again to the construction segment, where larger ticket items I think will take a little bit more time for people to really start getting into. Yes, they are trading below book value, but we also see that there is still wallet pressure constraints that are being felt across the board. Of course, in terms of foreign investments, there can be a lot more potential, but we haven't seen some of the numbers really starting to improve. So, for example, in terms of John Keel's Holdings reporting their sales of Cinnamon Life as well, it hasn't seen a significant improvement as of yet. I think that would be a good leading indicator to go by. But of course, at a certain point, because there is less supply coming in of apartments, there is a point at which property will start looking extremely attractive. But I think there's a little bit more time for that going forward. There's also a question in terms of our view on apparel sector and textile sector companies. I think if I was to broadly put it into export sector companies, we see that there is still quite a bit of pressure because of the global economic conditions, interest rate hikes that have kind of continued even after the Fed mentioned that they would pause interest rate hikes. So there is a lot more volume pressure being seen across that sector. And there is a lot more positivity surrounding the December as well as March quarters. So they do look attractive right now, even on a price to earnings basis. They do look attractive right now. Although in the very near term, there is still likely to be a little bit more top line pressure because of the volume constraints of the global economic conditions. And I think to close off, in terms of one question on the prediction on the all share price index in the coming months due to the changes in economic factors like interest rates and policy rate changes. We are quite positive in terms of the overall index. We think that it can reach 12,500 levels before the end of this year. As I highlighted within the presentation, driven by the lower interest rates, the shift in liquidity from fixed income to equities, the market requiring that kind of re-rating overall, corporate earnings improving, and also foreign investment coming into the market. As a result of that, we do see that there is space for the ASPI to reach about 12,500 levels by the end of this year. Yeah, I think that broadly addresses most of the questions related to stock recommendations that have been provided in the chat box. Thank you very much for joining this session. If you would like to invest in equities, please sign up for equities at cal.lk. And then we will be able to set up your A-Trade account for you, as well as online portal access, and in addition to access to our data platform, Analytical, where you can do your own kind of analysis and research with the financials as well as market statistics that are provided. Further sessions as well as our reports on this will be available for those who have equity accounts with Capital Alliance, and we'll be happy to see you at our next webinar. Thank you very much for joining.